Hello, I'm Brenda. Today I'm going to introduce two commonly applied asset allocation models and then discuss the key challenges in portfolio management. The principal component analysis model is a statistical analysis method to extract the principal components of variation from financial data. It aims to allocate asset weights by reducing the dimensionality of data and discovering the principal components. In asset management, PCA model is widely applied to optimize the principal allocation and enhance the risk management. I will demonstrate the PCA model by using the Dow Jones Industrial Average Index dataset from 2000 to 2019. This DJIA index includes 30 stocks, and the figure in the right shows the historical daily return of one of the constituent stocks, that is Goldman Sachs. The steps of PCA method is as below. Firstly, I performed the data pre-processing and constructed the covariance matrix. The figure shows the covariance matrix of these stocks. Then I applied the PCA model to reduce the dimensionalities and extract features from the data. Next, I visualized the cumulated explained variation to determine the number of principal components. As you can see from the cumulative explained variation plot, that the top 10 principal components account for more than 68% of the explained variation ratio. Based on that, I selected these top 10 principal components for the following weight allocation process. Then I computed the annual return, volatility, and Sharpe ratio for each portfolio. Based on this performance matrix, I ranked the portfolios and selected the top 3 portfolios with the highest Sharpe ratio. From this figure, it is obvious that the index number 0, number 10, and number 5 portfolios demonstrate the best performance according to the training set from 2000 to 2014. I selected these 3 portfolios and evaluated their performance by using on-sea data from 2015 to 2019. To visualize their performance, I plotted the following 3 time series plots. The orange line represents the return of equal weighted portfolio, which is the baseline, and the blue line represents the return of each PCA allocated portfolio. Based on the calculated Sharpe ratio, the number 5 portfolio demonstrates the best performance. It achieved an impressive annual return of 23.5% and the highest Sharpe ratio of 2.15. Since the optimal portfolio is a number 5 by PCA method, the table in the left presents the top 5 stocks with their weights in this portfolio, and the stock United Health Group holds the largest weight, accounting for around 22% of the portfolio. And the figure in the right illustrates the long-term stock performance of UNH stocks since year 2000. It is evident from the graph that the UNH stock price has displayed a consistent and significant growth since 2010. This constant upward trend aligns with the finding from the company's annual reports, which suggests that the robuster performance of this stock might be contributed to the implementation of healthcare reform policies and the increasing trend of population aging in the U.S. This experimental evidence demonstrates that the high weight of UNH stock in this number 5 portfolio can contribute to enhance the overall portfolio returns. Another widely used asset allocation method is the hierarchical risk parity. It aims to group assets assets based on their similarities and achieve a well-balanced risk allocation within the portfolio to ultimately reduce overall risk. I use the data from 30 stocks in the FTSE 100 index from 2010 to 2019 to demonstrate the weight allocation process of HRP model. And the figure below illustrates the price tendencies of 3 stocks from FTSE dataset with distinct or even contrasting trends over the period. The steps of HRP method is as below. Firstly, I calculated the covariance matrix of these stocks and generated the dendrogram to visualize the clustering and hierarchical structures. The figure below presents the dendrogram of these stocks. I employed the quasi-diagonalization method and the recursive bisection method to optimize the correlation matrix. This process divided the optimized correlation matrix into different submatrices. Following specific weight allocation principles, the weights of individual stocks were distributed to construct an optimal principle. In figure below, the pie chart presents the weight allocated of each stock within the FTSE 100 portfolio, and the table located in the bottom right corner displays the top 5 stocks with the highest weights in this portfolio, where DCC stock has the highest weights of 6.1% that determined by HRP method. This two-time series plot displays the performance of HRP allocated portfolio using in-sample and out-of-sample data. The orange line represents the return of HRP allocated portfolio, while the blue line represents the returns of equal weighted portfolio, which is the baseline portfolio. In the upper figure, it is evident that HRP allocated portfolio outperformed the baseline portfolio with the higher Sharpe ratio of 0.861. However, in figure 2.5 below, the HRP allocated portfolio displays the lower performance compared to the baseline in the out-of-sample data, especially in 2018. It implies that the HRP method may be influenced by the limitation of dataset or significant market changes over the period. There are several key challenges of machine learning technologies in portfolio management, such as low quality and imbalanced dataset, model overfitting on historical data, etc. I would explain data snowping bias in details. The data snowping bias is a phenomenon of excessive manipulating of historical data to uncover features that are not suitable in future financial market, which may lead to inaccurate investment decisions and increasing the investment risks. The proposed mitigation involves the application of NLP technology, the natural language processing, to process the texture information and extract valuable insights from various data sources, such as social media and public news. And emergent technologies such as reinforcement learning and transfer learning can enhance the decision-making in rapidly changing financial markets by interacting with real-time market data. And the cross-validation method plays a crucial role in validating the performance of models on unseen data. In summary, this research provides the valuable insights into effective asset allocation methods such as PCA and HRP, and highlights the importance of adjusting portfolio management algorithms with emergent techniques in these rapidly shifting financial markets. This is the reference, and thanks for listening.